Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings. And let me tell you, this latest NMI Holdings report is a doozy. We're talking about a company that insures mortgages, and this report shows how they've been navigating a tricky financial landscape over the last few years. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, so come join the conversation. NMI Holdings Incorporated, or NEI as they call themselves, is a company that insures mortgages through two main subsidiaries, New Mexico IC and RE1. They essentially protect lenders and investors if a homeowner can't pay back their mortgage. This is super important for the housing market because it helps people get loans for homes even if they don't have a huge down payment. Think of it as a safety net for lenders. They started up back in 2012 and wrote their first policy in 2013. Their stock is traded on the Nasdaq under the ticker NMI. When this report was filed, they had a pretty good market value on their shares, with over 76 million shares outstanding. Now, the mortgage insurance business is not for the faint of heart. NMI faces some serious competition. There are 6 private mortgage insurers vying for business, and they all offer pretty similar products. The report mentions that competitors might try to win over customers by lowering prices, loosening up their lending rules, or offering new kinds of coverage. This kind of competition can really put pressure on NMI's ability to make money and grow. And it's not just other private insurers. They also compete with government programs like the FHA and VA. Plus, lenders might find other ways to avoid needing mortgage insurance altogether, like having borrowers take out a second loan instead of one big one. With a high loan-to-value ratio, all these alternatives could mean less business for NMI. Let's dive into the numbers. As of the 31st of December 2025, their investment portfolio had gross unrealized losses of $86.3 million. A big chunk of that, $84.3 million, was from investments that had been losing value for over a year. This is a concern because while they believe they can still collect the money, it shows their investments aren't performing as well as they hoped, and it's tied to interest rate fluctuations, which can be a real headache. Looking at their core business, net premiums earned for the year ended the 31st of December 2025 were about $602 million. That's a healthy increase of 7% from the previous year. This growth seems to be driven by more people choosing monthly payments for their mortgage insurance. Their net investment income also saw a nice jump, up 21% to almost $103 million. This is thanks to a bigger investment portfolio and, importantly, higher interest rates, meaning they're earning more on their money. But here is where things get a bit more concerning. Their insurance claims and claim expenses shot up by a whopping 83% to nearly $58 million. This means more people are defaulting on their mortgages, leading to more payouts for NMI. This is a big red flag that the risks they're insuring are becoming more expensive. This increase in claims directly impacts their loss ratio, which went from 5.6% to 9.6%. That is a pretty big jump in claims relative to the premiums they earned. And when you combine those claims and their operating expenses, their combined ratio went from 26.6% to 29.5%. While still good, that increase in the claims portion is something to watch. Despite the jump in claims, their net income still grew by 8% to over $388 million. This is mainly because their revenue from investments and premiums increased, helping to offset those higher claim costs. Shareholders' equity also saw a solid increase of 17%, reaching nearly $2.6 billion. This suggests the company is building up its financial strength, which is crucial in the insurance business. They also passed their test from the mortgage insurance regulators. Their available assets were over $3.5 billion at the end of 2025. Well above the required minimums. This is important for them to keep operating and stay approved by those big government mortgage agencies, the GSEs. And their risk to capital ratio, a measure of how much risk they are taking on compared to their capital, was a healthy 13-1. This is well within the regulatory limits, showing they are not overextended with risk. The average reserve they set aside for each defaulted loan went up, which makes sense with those higher claim costs. This tells us they are recognizing that defaults are becoming more expensive to handle. Looking at their stock, they've been buying back shares, which can be a good sign that management believes the stock is undervalued. So, what is the story here? NMI Holdings is growing its top line and its investment income looks strong, which is great. They're also doing a good job managing their regulatory requirements. However, that significant jump in claims paid is a big warning sign. It means that the business of insuring mortgages is getting riskier and costlier. While they are still profitable and building equity, they need to keep a very close eye on those increasing claims. The hope is that their smart pricing and risk management strategies can keep pace with these rising costs. If they can't, those profits could easily start to shrink. A key risk mentioned is the intense overall competition coupled with rising claims, which is a tough combination for any business. They are also heavily reliant on the GSS, and any changes in those agencies' rules could significantly impact them. Alright, that is our breakdown of NMI Holdings' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.